inflation. And when most people talk about inflation, they're talking about price inflation. And that's just the general increase in the level of prices for goods and services. And you probably have a sense of that every year in kind of a normal economy, things seem to get a little bit more expensive, although not everything does. But especially if you look at something like healthcare or the cost of education, you definitely see things getting more expensive every year. But one interesting question is, how do you measure it? How do you measure inflation? And what the Bureau of Labor Statistics does, and this is actually the
Welcome,
most
guys, to the
used measure
exciting
of
stream.
inflation,
We're
they
going to
create something
await
called a
Jpow
Consumer
and
Price
watch some Khan
Index.
Academy in the
And the
meantime.
way
Maybe
they
we'll
do
learn
it
something.
is that they define a basket of goods.
Let me
And
know how
actually
my
a
sound
basket
is
of
in the
goods and
comments.
services. So what they do is they go and they look at the average urban consumer and they say, what do they need in their life? They might need some housing. They might need some fuel, some natural gas for their home. They need gasoline for their cars. They need energy in other ways. They might need some type of services. They might need transportation. And they try to come up with a basket of all of the things that the average consumer in an urban environment might need, and they figure out how much that would cost them in year one. And let's say that in year one, that it costs them $100, the actual basket.
So we're just going to hang out for a little bit and await the big announcement from Jpow today. We're looking at 75 or 100 basis points. Don't know which one it's going to be. I'm just waiting until after the announcement to really make my big move. So I've got some Khan Academy going on right now. We're just going to sit tight and wait for a little while. If you guys want to do some Q&A in the comments, that's fine too. I'm just going to let Sal Khan do his thing. And I'll turn my mic on if I need to.
The CPI constructs would not cost $100, but I'm going to do this for the sake of simplicity. And they'll weight these based on what percentage they think people spend on housing versus fuel versus services versus transportation. Then they'll look at the same basket each year after that. So then they'll do the same things: housing, fuel, services, transportation. And then this would be in year two now. In year two. And let's say that same basket costs $102. Well, then they'll say that the general level of price and services for this consumer went up by $2, or went up by, the more important thing is by the percentage, by 2%. So based on this measure, based on this basket of goods, prices went up by 2%. Or you'll hear people on the news say that the inflation rate went up by 2%. Now, I want to clarify, when inflation sometimes talks to inflation in the money supply. So people talk about there's just more money being printed. And often, an increase in the money supply is usually one of the factors that is driving price inflation. But when most people talk about inflation today, they're talking about price inflation. They're talking about the increase in prices. They're not directly talking about the increase in the money supply. Now, this seems like a pretty simple thing to do, but it's not as simple as you might first think. Because think about something like TV sets, or especially anything that's technological. Do you look at the same TV set that's
Tequila.
getting probably cheaper every
Chaser.
year, or do you look at the average TV set that the American household is having? Do you look at the same computer that's getting significantly cheaper every year, or do you look at the average computer every year? Because then you'd actually be looking at a different product. So there's actually a lot of things to think about, a lot of things how you could weight this, and there's been a lot of controversy and when the weightings change in different periods of time. But this is the general idea, and it's really just the best attempt to figure out, on average, how much more expensive or how much purchasing power are we losing from one year to the next. In the last video, we talked a little bit about what inflation is in the Consumer Price Index. And so I thought I would actually show you data and maybe point out a few interesting things right over here. So this right over here is the monthly press release, or it's a table from the monthly press release issued by the Bureau of Labor Statistics. And this is Table A, which is really a summary of all of the important things. It's the percent changes in CPI for all urban consumers, the CPI-U. And they do it for non or urban consumers and all the rest. But the CPI CPI that is quoted is the one for urban consumers, the U.S. city average. And what I always find is that the details are much more interesting than what you hear just on the news when people say, oh, the CPI changed by 0.5%. And one thing I do want to point out, and this is true of the CPI, this is true of all government statistics, and frankly, this is true of any report that any company gives you. It's very important to keep in mind whether they're giving a sequential change or whether they're giving a year-over-year change. So, for example, there might be a press release. There might be a press release like this one, and the text of it, or maybe the headline number when you look at your local newspaper or your news report, will say, look, in June 2011, inflation on all items, on the entire basket of goods, went down by 0.2%. And you might say, oh, wow, look, there's no inflation. In fact, prices are going down. This would be minor deflation. But it's important to realize that this is only the seasonally adjusted prices from May to June. From May to June. And when I talk about seasonally adjusted, and that traditionally maybe people use a different amount of energy, a different amount of gasoline from May to June, and they try to factor that in when they compare the basket of goods, the price of the basket of goods from May to June. So that's what they talk about seasonally adjusting. But if you look over here, the prices went down from May to June according to adjusting it for the season, but the year-over-year changes are still up. If you compare June 2011 to June 2010, it is still up by 3.6%. And in general, the monthly things are going to be a little bit more volatile. Obviously, you have the seasonal adjustments. You have other short-term factors that might change it. But the year-over-year one is a stronger signal for what is actually happening for inflation. Although someone might want to pay attention to the monthly one because that's obviously giving you kind of the most up-to-date of what's happening now. And what you'll often see is they'll give an inflation number for everything, and then they'll subtract out actually food and energy. So this is all items less food and energy. And that's because food and energy, they represent a good bit of the basket, but they're very, very volatile. You can see it right here in this report. Year over year, energy has gone up double digits, 20% for energy generally. If you look at fuel oil, 35.6%, at least on this report, has been coming down more recently, but year over year, it's been up a huge amount. And so that's actually the main driving factor for this 3.6%. If you take food and energy out of the equation, if you compare the basket of goods minus that, inflation was only up 1.6%. It's interesting, even within that, you can look at which parts of the economy or which products and services are getting a lot more expensive and which ones are getting cheaper. It's actually interesting that used cars and trucks are up 5.1%. That seems like a pretty strong price increase for used things.
Now I can personally say that used cars have absolutely gone up way more than they should have. In 2018, I bought a car for about $20,000. Now fast forward to this weekend, I ended up buying a very similar car, same amount of miles, same age, everything, for over $34,000. So we wind up with this massive increase versus 2018. We might see the year over year doesn't have that big of a difference. But remember what Sal Khan just said. When you have these increases, it's comparing to the year prior. So if you have a 2% 3 years in a row, that's not a 6% increase. That's I don't know, like 7.5%, 8% increase. So when we see these numbers, it's not as simple as it might first appear. These year over years can be deceiving when you're comparing them to several years back. All right, I guess we'll have the next one. What do we got? CPI index. So this CPI, this is the one that made a difference. CPI was 0.01 or 0.1. So you'd think, oh, that's a very small difference. But remember, that's comparing it to the year prior when it was I don't know what it was the year prior, but it was also pretty positive. And in August of 2021, inflation was running rampant, kind of still is, but it's increased even further since then.
It's talking about inflation and deflation these days, and
this one's a little loud. Let me know if this guy's too loud this time.
Including myself, and that's because it's important. And in order to really have an informed view on it, I think it's important to actually look at how inflation is defined. And right here, I actually took a screenshot from my Bloomberg terminal of the basket of goods that makes up the Consumer Price Index, the index that sets everything from the coupons on Treasury inflation-protected securities. This is the index that dictates what Social Security payments are going to, how fast they're going to grow. I'm sure a bunch of union agreements and pension agreements are dependent on the CPI. So this is the underlying basket of goods that really tells us what inflation is. And at a first level, it's just fun to look at because you can kind of compare your own household to what the government thinks is a typical household. For example, the government says that the typical household spends 15.7% of their disposable income on, and that's essentially the income that you take home after you're paying taxes, that they spend 15.7 on food and beverages. That seems reasonable, but it's even kind of more interesting that they break it down. I mean, they get very granular. They try to figure out how much you spend on, eggs and fish and poultry and bakery products, and that's good because let's say everything else stays constant, but the price of eggs goes through the roof because Atkins diet, the Atkins diet becomes popular again. Then you can actually make an informed decision as to why inflation is going up, or whether inflation will go up going forward. So that's just interesting to look at. And if you look at the major categories, the food and beverages, housing, and I'm going to come back to housing because this is, in general, just a very interesting area to focus on because it makes such a big portion of the CPI, and it's been such a big portion of the economic picture, especially the last 10 years. And obviously, it's become a big problem with it's become a big factor in terms of what's causing the financial crisis right now. But housing is about 43% of disposable income, apparel 3%, transportation 15%. This includes things like new vehicles 4%, used cars and trucks. And I think the way they calculate this is they say, what percentage of Americans are driving new vehicles versus used vehicles, and they put fuel in here. And just going to, the point that a lot of people, when I have this inflation-deflation argument, they make this argument that China and
I'm a little bit bored with this one. Do you guys want to watch something else? Let me know.
India are going to continue growing, and because of that, commodities like oil and fuel will continue to increase, although that's, people were making that argument more last summer, but even now people are making that argument. But in a developed country, you see that really motor fuel, even though it kind of hits your pocketbook on the margin, it isn't that big a part of kind of your total expenditure, especially when you compare it to things like housing. And if you keep going down, medical care, 6%. And then recreation. I mean, they break it down, and you could look this up. I think the Bureau of Labor Statistics has this broken down as well, though it was much easier to get it on the Bloomberg terminal. Education, on average 3%. Obviously, if you're sending your kids to college, that's a much higher number, but on average, if you take the average household. And finally, other...
I kind of want to see what year this is. Let's flip open YouTube real quick and see when this was actually published. This is 2009. So this is this is before the huge crash. It's a pretty old video. If you guys want to watch a different one, I'm going to be honest, I'm a little bit bored with this one. But let me know. We'll continue it for now.
Goods and services, tobacco, et cetera, et cetera. So that one is just interesting to look at. So whenever you have a discussion on the things that may or may not drive inflation, it's important to weight them by these weightings that the CPI gives them to actually figure out what the actual impact on how we measure inflation really will be. And with that said, if you think about it, the biggest portion of this is the housing piece, right? Housing, and I think that's fair. Housing is a large percent.
All right, we're gonna watch something else. I'm a little bit bored of that one. Let's see, where's economics, macroeconomics. Let's see what else he's got in economics. Micro, finance and capital markets. Let's see. Basic economic concepts, open economy, Keynesian approaches. No. Let's look at investment vehicles and hedge funds. I want to learn more about hedge funds because everybody talks a lot of shit about them. I don't know if they're really the bad guys. Let's find out. Let's see what Khan has to say. It's probably another 2010 video, but it's cool.
I want to see if we can understand the idea of a hedge fund a little bit better. And these tend to be pretty mysterious and sometimes get a bad name because some hedge funds do some fairly strange things and secretive things in the market, so people are rightfully so suspicious of many of them. But the real difference between a hedge fund and the types of mutual funds that we just talked about are that they're not regulated by the SEC. Not regulated by SEC. And because they are not regulated, they can't market themselves. They can't market. That's why when you watch financial shows or you get a magazine, a finance magazine, you will not see ads for hedge funds. The mutual funds are all over the place, marketing them left and right. Hedge funds, the largest hedge funds in the world are definitely not even household names. No one, very few people even know what those largest hedge funds in the world are, and that's because they can't market themselves, no matter how good of a track record or really how reasonable of a fund they might be. Some might not be reasonable, some are. They can't market themselves, and they also can't take money from the public. Can't take money from the public. So in general, in order to invest in a hedge fund, you have to be an accredited investor, which means you have a certain net worth, or maybe you have a certain income, or maybe by virtue of your education, you can prove that you have a certain level of sophistication to invest in these things that aren't regulated. You I guess, don't need the SEC to watch your back. And so the regulation is a key difference. Marketing, no money from the public. And then the other key difference is how the managers tend to be incented. I know incented's not a word, or motivated. In the mutual
Incentivized.
fund world, managers get a percent of assets. So for a mutual fund manager, larger is better. The more under management, the more money the mutual fund manager is going to make. So they really just want to keep marketing it and marketing it. They don't get a cut of the profit. So really, there's not a lot of incentive to try to make kind of really beat the market here, because if they kind of don't beat the market one year, then all of a sudden their fund will shrink. So they really just get a fee on the size of the fund. In a hedge fund, usually the implication is that a hedge fund will be more actively managed. They'll get a larger management fee. So larger management fee. Instead of the 1%. 1% is actually a lot for a mutual fund. Instead of that, hedge funds tend to be 1 to 2%. So 1 to 2% management fee, and sometimes even larger than that. But the even, I guess, bigger difference, and this is where hedge funds are very different from a traditional mutual fund, is that the management company, the general partner, gets a percentage of the profits. So in a hedge fund manager or the management company, the going rate tends to be about 20%. 20% of the profits of the fund. Sometimes it's less, sometimes it's a lot more. Some very successful hedge funds get 25, 30%, or even a larger percentage of the profits. So with that out of the way, in the next video, I'm going to do some different mechanics of essentially the same returns, but one by a hedge fund and then one by a traditional mutual fund.
I think that model is actually better, where you share part of the profit instead of just taking from assets under management. I mean, 20% is a big bite, but if they're making a lot of money for me, it's worth it.
Let's see if we can understand the structure of a hedge fund a little bit, and also how the management and the performance fees work out. So most hedge funds, the funds themselves, are set up as limited partnerships. So this is the hedge fund that Pete set up. We'll call it Pete Capital Fund 1. He's maybe in the future going to start Fund 2 and Fund 3 and all of the rest. And he's able to raise $100 million. 10% of that $100 million, or 10 million of it, is coming from him, or I guess to be more exact, it's coming from Pete Capital Management LLC, limited liability company, which he starts off as the general partner of this fund. And just, it might be a little bit confusing, but this is one company, this is another company over here. This company is going to manage the assets of that company. And in return, it will be able to get management fees, and it will be able to get performance fees, and we'll talk about that in a second. And probably Pete owns this entire company, but he might have a couple of employees, probably 4 or 5. Now, the way it works with the limited partnership is they don't call it necessarily shares, but it's essentially the same thing. Someone who, out of this 100 million, contributed 30 million would get 30% in limited partner interest. Someone who contributed 10% would get 10 million in limited partner interest. So let's just say that he does really good over the next year, that he's able to, on a gross basis, before we take out his management fee or anything else, grow the fund by $20 million. So roughly on a gross basis, 20%. But this is net of, the trading fees and all of the stuff that he has to pay the broker and all of that type of thing. To understand kind of what goes to Pete Capital Management that Pete can use to pay himself and his handful of employees. First, he gets the management fee, and the management fee will be on the average net asset value. And I'm going to do it a little bit back of the envelope right over here. It's normally done on a monthly basis, but I don't want to go into all of the accounting. But if he did this fairly linearly, or if he does this fairly consistently, the average net asset value over the year would be about $110 million. So average would be approximately $110 million. And so he'll get about 2% of that. We're assuming he gets a 2% management fee and 20% performance fee, or 20% carried interest, it's sometimes called. So if the average net asset value is 110 million, you multiply that times 2%, and then that means that he's going to get $2.2 million in management fee. And this is for his salary, his employee's salary, to pay the rent, to, I don't know, get some fancy computers, whatever it might be. This is kind of viewed as the cost just to manage the fund. So we need to subtract that from the total amount in the fund, because that's going to the management company. So instead of 120 million over here, we're going to have, what is that, 117 million point 8. 117.8 million. And then we'll have to calculate how much he gets in a performance fee. So in this situation, net of his management fee, we have a $17.8 million gain. So let me write that over here. We have 17.8 million in profits. The way that we've set up the performance fee, or the carried interest, is that Pete gets 20% of it, or more particular, the general partner, the Pete Capital Management LLC, the partner that is controlling, that is managing this fund, will get 20%. So let's multiply that times 20%. And what does that give us? That gives us 3.56 million. So 3.56 million will also go to Pete Capital Management. So not bad. And this year he made a little, almost $6 million, and that's probably going to go to him and, probably 4 or 5 employees. So it can, if someone performs well, it can be a very profitable business. And just to make it clear how the mechanics work here is that these funds tend to be open-end funds, like open-end mutual funds. Well, not like them. They have to be private. They can only take money from accredited investors. They can't market themselves. They don't have to register with the SEC. But when I say that they can be open-ended, it means that at any point, well, not at any point, usually this is restricted, at certain points in time, the investors are allowed to redeem or kind of add investments to what's going on in the fund. So let's say at the end of the year, so instead of 117.
Hey, do you guys want to keep watching Khan Academy, or do you want to see like the behind the scenes of a video? Or do you want to watch something else? Y'all just let me know. We're going to sit around for a little while until the market starts picking a direction ahead of Jpow, and we'll check that out. And then, of course, we'll watch Jpow himself.
8, we're going to have to subtract 3.56 from that for Pete Capital Management. So what's left in the fund is going to be, and he could leave it in there to reinvest, but that would just increase his share. But let's say Pete Capital Management takes it out, so we'll be left with, let's see, we have 117.8 minus 3.56, right? Minus 3.56 gives us 114.24. So over here, what's left in the fund is 114.24. And let's say at this period, investors are allowed to redeem their interest. And let's say this guy right over here, this guy with a 30% interest, he says, you know what, that was a pretty good year. I want to take 10% of my interest out. So instead of having a 30% interest, he wants to have a 10% interest. So what happens is, so instead of a 30%, this is now a 20% interest. He'll take 10% out. So he'll take 10% of 114.24. So he's going to take out, that's essentially going to be, we just have to move the decimal place 1 over. So he's going to take out 11.424 million. That's this guy right over here. He's going to take out 11.424 million, and then the fund will decrease by that amount. So he can, at these specific periods, people can redeem. Usually it's at the end of the month, at the end of the quarter, or the end of the year. And so then the fund will be left with, what's 104? Let me take the calculator out again. The fund will now be left with 114.24 minus 11.424, which is going to be 102.816. 102.816. And at the same time, other people might say, hey, gee, that was a pretty good return. I'm going to now contribute to the fund. So either way, it's not like it's a closed-end fund where just at the beginning people can commit their capital and they can't take it out until the end of the fund, or they can't add more. During the life of most hedge funds, at specific periods, people are allowed to redeem their funds or they're allowed to add more funds.
So this is attempt number 2 at getting
I just did that whole thing with the mic off.
Screenomatic video recorder to work. So now I'm testing.
Somebody wanted to look at my old videos. So this is my very first video from like 2016 when I was testing out my software.
Without using my webcam to see if it gives me some better results. Let's try doing a little bit of web navigation here.
I didn't think I had an actual mic.
And will it load faster? It looks so far like it will. Still painfully slow. Maybe it's not actually faster. Maybe it is. Okay. So let's look up goats. And see how long it takes for it to actually come back to us.
If I was on mute for 25 minutes, somebody would have told me by now. No, it's that last part where I was explaining why I'm going to this.
Primarily for its milk. This is news to me. So, anyway, I'm a big fan of goats, actually. I think they're a pretty worthwhile animal. That is a very good looking goat there on the left, the white Irish goat with horns. Very good looking goat.
I don't even think I had a microphone when I first made these videos.
It's actually pretty interesting. Reach puberty between 3 and 15 months of age. That's super young. But we like to delay until they are 70% of their adult weight. That is interesting. Goat kid, 2-month-old goat in a field of capeweed. Goats are well known for being hard to contain with fencing. That's actually really funny. Wow. Alright, so goats have a life expectancy between 15 and 18 years, which is actually pretty long. That's longer than you're going to get out of a dog. Even the smallest dogs usually don't live that long. Problems during kidding can lower those expected lifespan to 10 or 11. Stresses of going into rut. What is rut? I do not know. The goat is useful to humans when it is living and when it is dead. First as a renewable provider of milk, manure, and fiber, and then as meat and hide. Yeah, that's pretty fair. Alright, I think that's good for our testing. Let me just scroll up one more and make sure that this is capturing if I do some crazy shit. And let's do a final test here at the end. Right clicking, what does that do? Left clicking, does that make things show up? What happens to my mouse when I click? If I want to show something in particular, do I click on it? What if I want to demonstrate this picture without clicking on it? Do I just have to click near it? Or I click on it and drag?
So as you can tell, even if you've never had much of an idea of how to start a YouTube channel, the origin is very humble. You know, you have me talking about goats while flipping through. Like, this is how you experience creating content for the first time. So there's really no reason to worry about, is my quality good in the very beginning. If you want to become a YouTuber, you can start with ridiculous activity. So let's see what this is. The next one. Oh God, this is going to be embarrassing. So this is March 21st of 2017. This is when I first discovered the wheel strategy. Now I think I had the whole thing figured out. I was ready to dominate the market using the wheel. So this is more than 5 years ago. This is how I decided to approach this topic. So let's watch. When I taught, so a little bit of background. This is when I first decided to attempt Kamikaze Cash. This was in 2017. I had absolutely no equipment. I had no experience. I had nothing. I didn't even have a microphone. So I was just using my own laptop in order to do this. The first attempt at making a YouTube channel completely failed because I didn't know what I was doing. I had nothing. I came back to it later, a couple of years later, and things went better, obviously. But this is the original Kamikaze Cash, and this is me talking about how the wheel strategy is going to absolutely dominate the market. It's going to be a little bit cringe, but stick with me.
What I want to do in this video is give you some background on our strategy and talk a little bit about how it works. So let's start off by taking a look at the stock market in general and how it works. So the stock market will have its ups and its downs. When it's up, it's called a bull market. All right, and then it'll start going down. This is called a bear market. And sometimes there's extended periods of time in which the stock market doesn't go up or down. It just kind of stays flat. But generally over time, you'll see that the stock market, through all of its ups and downs, has an upward trajectory. It'll continue going up over time. And in fact, if you pick any date in U.S. history, 11 years from that date, the stock market will always be up, and you will have made money no matter what point you invested at. All right, so this is what the market generally does over time. All right, it has its ups and downs, and then continues up. So overall, we're looking at every year about an 8 to 10% increase, which is great. Now, people generally invest in the stock market. What they're looking to do is just ride these waves up and down, and then one day, when they're rich enough and they plan on retiring, they'll sell their stocks and pull money out, or they'll pull some money out and keep the rest of it in. But what's unfortunate about that is that, as great as it is, people generally don't see any money from it until they're ready to retire, until they're at a point much later in their life. And when they do actually take their money out, they'll be very happy, because if you've invested and you've done so with discipline, then you'll have made money over time and you'll be very happy in your retirement. But for us, that's not how we like to do things, because we want to have the opportunity to make money and bring it home and stay on top of the market and make money over time and make more than just what the market would normally bring you. So the stock market,
For those just joining, this is my first attempt at making Kamikaze Cash back in 2017 before I gave up for a couple of years. So this is that original video of me talking about how the wheel strategy is going to dominate everything else on the market, every other strategy you could possibly use. So this is that cringe stuff that demonstrates that you don't have to be good at YouTubing in the very beginning to get started.
is the yellow line. Let's make ourselves the blue line here and describe how we do things. So let's say you start off with a certain amount of money and you're riding the market up just like everybody else. All right, you're in the bull market, you're enjoying it, you're making money. And then you see signs that the market is starting to level off. Stocks aren't going up as quickly as they used to. They're flattening out. And this means that the market has increased enough in price that we're starting to see resistance. And resistance means that sellers are coming into the market, they're taking advantage of the increased prices, and they're going to start selling their stocks. They're going to take their money while they're up and run with it. Now, what we're going to do, since we're not ready to cash out all of our stocks yet, we're going to do what's called selling a covered call. And we're going to squeeze some extra money out of the stock market. We're going to squeeze some extra cash, all right, through selling that covered call. And I'll be explaining this strategy in more detail in a later video. But for discussion, let's say that what we've been able to do is sell this covered call, and through that we've made an extra $100. All right, so we'll be conservative and say we made $100 on it. All right, and now that's our money. You can do whatever you want with that money, whether you want to continue, you want to reinvest it, you want to pay off debt, you want to cash out and go have a steak dinner, whatever you want to do, that money is yours. All right, it comes directly out of it. If you want it to, you can pull it directly out of your investment account and do whatever you want with it. All right, but now, no matter what you do, you're going to be $100 above the market. You get to keep that money. All right, so as the market goes down, we're starting to ride it back down along with everybody else. We're still $100 up, $100 above where everybody else is, and $100 above where you would be if you didn't use this strategy. So now the market has gone down a little bit, and we're going to start to see things leveling off again. So rather than seeing resistance, like we saw over here, we're starting to see what's called support. And that means that the stocks have gone down enough, investors are interested, the stock market is low, they're going to buy stocks, and they're going to take advantage of the nice low prices. Once we start seeing signs, volume is picking up, and I'll explain what volume is in another video, and the prices are starting to level off, we're going to squeeze some extra cash out of the market. We're going to squeeze cash from this bear market and essentially build a bridge to the next bull market. All right, now let's say, just for discussion, that by selling a cash-covered put, which is what this strategy entails, we make an additional $100. So when the stock market goes down, we sell cash-covered puts. When the stock market goes up, and it's kind of hitting a peak, we sell covered calls. So now we're going to continue riding the stock market up. Now we're not $100, but $200 above the market. We're riding it up. And then again, we're starting to see some resistance. The stock market is leveling off. We're not seeing quite as much volume as we used to. It's looking like things might start to go down. So again, we're going to sell a covered call, and we're going to squeeze. Let's say we scored this time. We did well. Actually, this is probably about average what you should expect to see. Let's see what we were able to do is get not 100, but $200. And that's a pretty fair amount of money to make on a trade like this. You should generally expect between $150 and $200 when you use this strategy. So now what we've done is we've squeezed not 100, 200, 300, but $400 out of the stock market. We're $400 above where everybody else is who's just riding the market, and $400 above where we would be if we weren't using this strategy in order to make additional money. All right, so just like we expected, we've squeezed money, and the market is starting to go down. And again, we're going to see some signs of support. All right, things are leveling off. Stocks they're not going down as much as they were. We're starting to see some more support. So what we're going to do is use the same strategy again, and you'll see how this continues. So again, we're going to squeeze. We're going to sell a cash-covered put. And
those that are just tuning in, this is my first video from 2017, and it's talking about how the wheel strategy is going to absolutely dominate. Now, obviously, I've kind of evolved a little bit, got a little bit different view. We'll talk about a review of this video at the end, but honestly, it's not as cringe as I thought it was going to be. Coming back to it here 6 years later.
Pull an extra $200 out of the market once again. All right, so I won't bore you by continuing this any further. Let's just say we're going to continue. You can see that our trajectory, our investment is actually getting substantially higher, because now we're a full $600 above where the market normally would have us. So we're getting quite a bit extra out of it. So now to put some numbers to this is generally what you should expect to see if you invest about $50,000 4 trades later. So we're looking at about a month, maybe 5-6 weeks afterwards. And what we've done is been able to pull $600 in extra cash out of the stock market. So we're going to get a little extra bread here. That's pretty nice. So $600.
I do want to give myself credit for is not using any video editing when I made this back in the day. I didn't have Vegas Pro, I didn't have Adobe, I had nothing. So this was all one take. And if I remember correctly, I practiced it like 10 times before I actually did it. So, I mean, I guess we could watch the rest of it.
And you might say, Mikey, what's going on here? I invested $50,000, and the best your strategy can do is just give me $600. That's all you got for me. Yeah, in some ways that's true, but remember, we're not just benefiting from the extra money that we've made. The stock market has gone up over this time. So we started off way down here at just $50,000. All right, but look what the market's done since then on its own. All right, without our strategy, we started with 50,000. Now up here, we're probably about a month later. On a good month, you might make 2%. So let's say that what we're actually at the end of the month isn't $600, but the market has already given us, let's say we're at $51,000. Just in the stock market alone is at $51,000. And then by using our strategy, we're able to add an additional 600. So we're not at 51,000 making a 2% return. We're actually now at $51,600. All right, 2% in a month is already pretty good. That means that the stock market has gone up very well. But now we're looking at not just that extra $1,000, but an extra 1,000. This is 6 here. Forgive the 6. An extra, we're looking at more like 3%.
I love how my idea of selling covered calls over 1 month was 4 different covered calls, each of them at the money and not getting assigned a single time. That was my idea of how to run the wheel when I first started trading. And honestly, it's not totally unrealistic. It wouldn't be possible to see both a bull market and not getting assigned on at the money covered calls. Like, this would have to require that you sell quite a bit out of the money, or your timing is perfect, which is just impossible. So we'll do a review of this at the end. Let's let it keep running. Let's let Mikey from 2017 talk out of his ass.
Here, so we've done a little more than 3%. So this would be a great month for us, making an extra $600 on top of $1,000 already. And in other months, you can actually see that this is even more dramatic. So by being able to continue the strategy, you end up making a pretty substantial amount of money on top of what the market already gives you. And I've personally been doing this for a couple of years now, and it's worked wonders. You can really tell the difference when you're looking at the end of the year and seeing how much money you've made. And I'm going to continue using it because it works out so well. I'm really not kidding when I say that this is probably the easiest way, the most basic way to add to your income over time, rather than just invest passively. So let's take a look at what an actual stock chart looks like. So this is the S&P 500's ETF. Now, of course, it's a lot more choppy than what I actually drew online just for demonstration purposes. But you can definitely see circumstances where the stock market has gone up. All right, now it's starting to level off. And what we would do is sell a covered call in this case, and we would have a little extra money on top of that. So an extra couple $100 we would walk away with. Now, as the stock market goes up and down, whatever it does, we're going to keep that money and we can use it, we can reinvest it. All right, and here you see a downtrend. All right, in this case, it kind of spiked back up, so it would be difficult to time. But we look for opportunities to do it. We can start to see that there was the market had gone down substantially, and then we started seeing these are called candles, smaller red candles. And we would take this as an indication that the stock market is going to reverse trend. And we would sell a cash covered put. All right, so we'd build that bridge to the next bull market and walk away with a little extra, and we would continue climbing. All right, so this is a good example of how we would actually use that strategy in real life. And now at this point, it looks like the stock market has finally taken a hit. We've been anticipating for a while. We sold some calls, and we actually sold stock in this case too because we expect it to go down. And now it looks like that trend is starting. So we're going to wait for it to go down a little bit more, and then we're going to sell a cash covered put and take away that little extra money once the market starts going up again. All right, so in conclusion, this is the gist of our strategy. There's some risks that are associated with it, even though it is one of the lowest risk strategies that you can use in the stock market. So what I'll do in the next video is describe a little bit more in some detail about how we actually use this strategy and talk about how we can manage the risks that are associated with it. All right, thanks for watching.
Okay, so credit to myself, there were it's not totally bogus information. I thought that was going to be a lot more cringe than it actually was. It wasn't super entertaining, but I do want to point out I had no equipment. I had no experience. I was going in raw on producing a 11-minute YouTube video, which is really not that bad, especially for having no editing software. But here's what's bogus about this. This is where the mistake came in. So I'm talking about the market goes up and starts leveling off, you sell a covered call. Okay, that's fine. The market goes down, you sell a cash secured put. All right, this is where the problem comes in. So if I see the market starting to come down, all right, and then it starts leveling off again, I say, okay, now is the time to sell a cash secured put. I feel like the market has gone down enough. It's going to start going up again. I want to sell a naked put. All right, that's fine. But when you do so, you have to be willing to either take assignment and probably dig into your margin availability, or you have to already sell the shares first. You have to sell your shares in order to sell a cash secured put. What I wasn't taking into consideration is that if you have 100 shares and you sell a covered call, you're good. But if you have 100 shares and you have no cash left, you can't sell a put unless you're using your margin allowance. So you're taking on the additional risk of getting assigned if the market goes down lower than you expect. Now you're stuck with 200 shares. All of it is in the hole. So that's problem number one. And then problem number two here, we look at the actual, like where I'm showing a graph of the market. Let's look at this, for example. All right, I see the market starting to come down. I sell a covered call. Okay, that's fine. Now, market goes down to here, this point where it's at like 206. If I were to sell a put right here, if I were to sell shares and then sell a cash secured put, the market's going to go flying. I would have been a lot better off just holding the shares than I have by selling my shares and going to a cash secured put. So in this case, I would outperform the market in this area, and then I would underperform the market in the rest of the time. So the wheel would not have been effective in this case. The only way to make it work would have been to use margin allowance to sell puts naked. And you can do that, but it's not what I was describing over here. This is a cash secured situation. It's not going to outperform the market in this case. But hey, this isn't. But you know, for having something that's been unlisted for so long, 47,000 views is not bad. Also goes to show you can become a YouTuber without really knowing what you're talking about. You just have to have some information to provide people. I don't know. I kind of want to see what the comments look like here. Oh, I did have kamikazecash.com. This is long gone. I own the domain, but there's nothing there. And then, okay. Skater Freak, numbers, buy high, sell low, best strategy ever. Like, here's some comments here. These are all from a year ago. They're not from like 5 years ago when I started this. What's the oldest comment? All right. Mr. Delta says, this is investment. I don't even want to say the word. I'll get demonetized. If it was that easy anticipating highs and lows, you would be rolling in billions. Technical analysis does not work. Your strategy will almost certainly underperform a broadly diversified index fund in the long run. If you're having fun doing this, all fine, all power to you. But for the general public, this is horrible financial advice. I don't know if it's horrible, but he is right about something. The way I was describing always using a cash secured situation, that will underperform the market. How did I counter dunk on him? Yeah, selling covered calls and cash secured puts is way too advanced for the average trader. Just stick to holding SPY if this is too hard for you. So I think I was trying to dunk on him, but I actually gave him like legitimate information. He says, what's your annualized return over the 15 years after cost? Or 10 or maybe 5, depending on how long you've been investing. I said, my 3-year return is 69.39 versus the S&P is 45.52. I think that actually is true. I didn't lie to him. I chose 3-year because the longest option my broker allows me. So I think that actually was accurate information, but when you're making money between 2014 and 2017, it's not that impressive. So, all right, people are dunking on Mr. Delta. Yeah. Bad luck for 2020 curse. Just want to see a little bit more. I dropped out of high school, and then we get the bots coming in here. Yeah. Jorge Delgado says, if I wanted to see someone blow smoke out their ass, I'd just go to Tech Conversations on YouTube channel. Yeah. Anyway, all right, let's see Papa Jpow. So the actual announcement should be out any minute now. He's not going to be speaking for a little while, but let's get the FOMC website up. What the hell is it? FederalReserve.gov. Let's see if there's... The announcement should be out right now at 2 p.m. So where are we at? Somebody help me navigate this website. I usually just wait for Jpow, or I just wait for the market to figure itself out. All right, somebody says the market's crashing. Yep, that is a crash. Oh, geez, we just gave up all of the day's gains. So what happened here? It looks like the dump is here. Awesome. So I just closed out of my call credit spread today for a very modest gain, like $20. So, but I just wasn't comfortable holding going into this meeting. So I'm just going to jump back on board. All right, now let's see the press release. All right, here it is. Reserve Board, so this is today. All right, here's the tables to summarize economic projections. Okay. What do we got? So Jpow says, in conjunction with the Federal Open Market Committee meeting held yesterday and today, meeting participants submitted their projections for GDP, unemployment, etc. So where is the big announcement? Let me get the bottom line up front, please. So GDP looks like we're rolling it down. We're below 2%. 2022, real change in GDP is 0.2%. So not quite a recession, but it's lower than it was in June, apparently. Unemployment rate, no real change. PCE, So they're actually expecting PCE to increase. What the hell is PCE? Personal consumption expenditures. Yeah. So this didn't, this kind of sucks, guys. I'm gonna be real with you. What is the market doing right now? Let's see. How long are we gonna eat shit? Here it is. Fed again hikes interest by 75 basis points in aggressive bid to fight off inflation. Let's see what we got. Where's my sound? Thank you.
5 basis points. That's what the street is expecting to hear from Federal Reserve Chair Jerome Powell today. The latest rate hike decision will be announced today at 2:30. And joining us on what we should expect from the FOMC meeting is Yahoo Finance's Jennifer Schonberger. Jen, good morning. You are live from the Federal Reserve in Washington. And so
good morning. That's right, Brad. I am live here in Washington from the Federal Reserve. In this building behind me, policymakers are commencing the second day of their two-day policy meeting, where they are widely expected to raise that benchmark interest rate by 3/4 of a percentage point when they conclude their meeting at 2 p.m. By the end of this year, according to this 2.25 to 2.5, this would mark the third 75 basis point rate hike in a row, an unprecedented move since the Federal Reserve has started explicitly targeting the Fed funds rate since the 1980s. The Fed likely to signal that they will raise rates more aggressively and expects rates to be higher for longer when they release that so-called dot plot, which is the individual interest rate projections of each Fed official. Now, markets expect the benchmark interest rate to rise above 4% by the end of this year, according to the CME Group. However, how high, how quickly, and how high rates remain at those levels remains uncertain. Officials also expected to release new projections for inflation, unemployment, GDP, which will give us a clue into how they see the outlook for this economy and setting monetary policy, and how perhaps tighter policy will factor into that. We'll hear more from Fed Chair Powell this afternoon when he gives his press conference at 2:30. Guys? In times of uncertainty,
My dumbass forgot to turn on my mic again. All right, so that was old footage. It looks like this one's live, so we're going to go over here. Breaking news. Fed raises rates by 75. It's kind of lame, honestly. I was kind of hoping they would do 100 and just to rip this Band-Aid off and wrap this up. So there's a couple people in here saying that they didn't like me talking about Moo. Hey, man, you got to short China. All right, China is in serious economic trouble right now. I mean, they are struggling. The goal here, when I say you got to open your doors to China, I'm not talking about buying shares. I'm talking about puts. I mean, I sold all my exposure to China. You got to do the same thing. That's all I'm saying. You know, I don't want to tell you how to invest, but I mean, let's be real. This is not about buying China. It's about selling it. All right, let's check out the live announcements here.
And well, the labor market especially is extremely
Her sound
tight.
is
It's
terrible.
very,
That's not me. That's her.
unlikely to see a recession when the labor market is as robust as it is now. But I do think that what the Fed is essentially trying to do is almost engineer a recession. It's almost the only way that they would be able to push down inflation. When we think about recession, yes, they keep going until they have raised the unemployment rate sufficiently. And unfortunately, that implies that a recession is almost inevitable, I think, next year.
Okay, Michael. So is there any concern that there was just too much, too fast at this point by the Fed, not letting the medicine take hold?
Yeah, I think there's concern there. I mean, monetary policy, somewhat famously acts with long and variable lags. But I think the way the Fed thinks about it is, inflation is still so high at this point. If inflation was 3% or 3.5%, I think they might be willing to look at it a little more symmetrically and say, well, that's only a point and a half above our 2% inflation target. Let's digest this pace of tightening. But when you're running at, an 8% year over year and 6 or 7% on a 3-month annualized rate through core inflation, inflation. And when it's been this high for going on a year now, I think the Fed looks at this as no longer a symmetric situation. And so you certainly run the risk of going too far too fast, but I don't think the Fed is there yet, and neither do we. I think there still needs to be more policy tightening to get this inflation in check from what is well above the 2% inflation target where we are right now.
Seema, just your reaction on what we're seeing play out in the bond market right now. We have the 2-year rate here surging to 4.11. Obviously, the 2-year most closely tied to Fed policy, what we could potentially see play out here in the economy over the coming months. Just what's your assessment of the strong move up that we have seen in yields, especially at the shorter end of the curve?
Right. Well, I mean, I think it has to be expected that this kind of move would happen when you see the Fed as aggressively hawkish as they're conveying in today's decision. From here, we think that there could even be further movement up on the 2-year if inflation continues to be extremely stubborn. But I mean, on the 10-year point, we think that it can stay relatively elevated, kind of where it is today.
Hey, thanks for the super chat, Derek. I appreciate that.
But then as you get closer to that economic weakness really starting to come through and recession comes into view as well, at that point, you could see some downward pressure on 10 years. But at this stage, there's very, very little to push it down as long as the Fed is hiking and the economy stays robust for the time being.
And Michael, speaking of robust, as we look at the sector action, it's really only consumer staples now in the green after this announcement of the 75 basis point hike. How important is the consumer going to be in terms of what happens going forward, especially when you look at things like earnings?
Oh, I mean, it's tremendously important. Consumption is 2/3 to 70% of the U.S. economy, and so that remains the big engine here. As you've seen other parts of the economy, be it residential investment, or obviously there are a lot of problems abroad when it comes to global growth. And consumption has been really remarkable when you think about all the challenges we've had this year, starting with the Omicron COVID wave back at the beginning of this year, over the winter, through of course the commodity price shock that we got, and just the inflationary pressures more broadly, and the many hurdles that consumers have had to jump. We've still seen decent real personal consumption growth. But of course, that has been sort of on the back of this very strong labor market. Month in, month out, we've been adding hundreds of thousands of new jobs a month. I think the question really going forward is, as those tailwinds start to fade, as you're not seeing job growth like that, if unemployment rises next year like we expect and like it sounds like the Fed expects, is it really realistic to expect consumption growth to remain very robust? I'm a little bit skeptical.
And Seema, what do you want to hear from the Fed chair today? And specifically, how do you think he'll address the pain ahead for the labor market, to Michael's point?
Well, look, I think we have to think about this. For the Fed, this is going to be a very, very difficult time. And certainly for the U.S. economy, it's going to be extremely challenging. But they need to hike rates very aggressively now in order to ward off an even worse scenario later on. So in a way, I think what we are hoping to hear from Powell is almost him invoking his inner Volcker. Talk about the inflation fight, something that it is pernicious. It has to be done, that they need to achieve this price stability. And I think by doing that, unfortunately, along the way, that does mean that the unemployment rate is going to rise. And they have to acknowledge that there will be pain, but it's something that they have to go through in order to hit that price stability target, which is of the utmost importance.
I wonder if Jpow likes his job.
All right, Seema Shah, we will check in with you in a little bit, so if you could hang with us here. Michael Puglisi, thanks so much for joining us here this afternoon. Well, again, let's take a look at at rates here in terms of treasuries, because we're seeing some movement in the yields. The 10-year yield spiking to the highest level that we have seen in just about 11 years. The 2-year yield now at just around 4.11. Again, the highest that we have seen since at least 2007. We want to bring in Ellen Gask. She's PGIM's fixed income lead economist. Ellen, it's great to see you. In terms of your reaction, what we just heard from the Fed, what we just got from Jpow, a 75 basis point hike, is that enough?
Well, the 75 basis point hike today was expected. I think, though, their projections, it looks like they pulled forward their expected rate hikes a bit from what we and the markets were expecting. They've got basically another 100 up to 4.5% by the end of this year, a little higher than we had expected, and critically signaling that they expect the funds rate will stay high, maybe even move a bit higher next year as well. So persistently tight policy here through the next year and a half. So it was a little more aggressive, I think, than expected. The unemployment rate a little bit higher projected from the Fed than I had anticipated. So they are signaling they are serious about this.
Hey, do you guys want to continue watching this, or do you want to talk about what it actually means to be raising rates? You let me know. And one more thing. Do you guys think Jpow raises the market or crashes the market further when he starts speaking?
Critically, though, if you look next year with a 4.6% Fed funds rate they're projecting, they're also expecting inflation will moderate. The PCE deflator, their preferred measure, down to 2.6%. That means next year, their funds rate will be outpacing inflation finally. They will be sufficiently restrictive.
And a lot of people wondering what this means in terms of GDP projections.
It sounds like people generally don't feel like listening to people on Yahoo Finance talk anymore. So we've got about a little less than 20 minutes until Jpow does his big speech. And do I think it's going to go down or do I think it's going to go up? Honestly, it is a dice roll when Jpow is talking, because even the slightest change in his language could completely change the way the stock market is going. He could say, we will aggressively use our tools, or we will use our tools, and that could be enough to start sending the stocks in one way or another. So I'm not playing this. I'm going to wait a few hours, probably until close to the end of the day. It sounds like my 2-year-old needs me, so we're going to watch this for just another minute while I stop my 2-year-old from crying, and I'm going to come right back downstairs.
The economy that's going to ultimately be part of the solution to these high inflation pressures. So overall, there's a chance here still for a soft landing, but the Fed is moving so rapidly against rapidly changing domestic and global conditions. Admittedly, the risks of recession are elevated at this point, and given the aggressive pace of the Fed and other central banks, recession risks are now higher. The soft landing, that's a very fine needle that has to be thread here.
What does the Fed need to accomplish that?
Well, I think we need to see some rollover in these inflation pressures, a natural rollover that I think we've been seeing nascent signs of, but inflation has been more persistent than expected. We had an inventory cycle now finished playing out. That put pressure on production and demand while companies were restocking shelves alongside households and businesses reopening and the COVID boost from them. But that's now played out. The fiscal stimulus has played out. The drag from its end has also now played out. So I think the very volatile fiscal policy should dissipate, and that would go a long way, I think, also to put us on an even keel here. But again, the global backdrop is one of elevated risks. Global energy prices right now, they're cooperating with demand destruction from China, from Europe. The softening of energy prices, oil prices, is really helping U.S. consumers. But that is at risk here this winter going forward. So it's going to be challenging. It's not impossible for a soft landing, but certainly challenging.
And I guess what I was getting at, Ellen, is beyond their control. Let's say an end to the hostilities in Ukraine, the COVID China lockdowns. Is there something that could change this equation dramatically for the Fed?
Yeah, so I keep looking towards what's going to happen to companies and they're willing to invest. To me, that's the long run solution here that would boost growth and dampen inflation pressures. If the Fed hits the brakes so hard here that companies start to pull back and pull back quickly, hiring not just slows but really dries up, the labor market is decimated. That means that the supply side of the economy, it is really going to freeze up. And that's something that's been so different in this cycle, the challenges on the supply front. The Fed trying to dampen demand conditions has to be careful that it doesn't inadvertently too much dampen the supply side. The housing market is a key example where the froth is coming out of it. We've seen existing home sales decline now 7 months in a row. Demand is slowing. But it's been a tight market for over 10 years now, very challenged in terms of supply. And Fed tightening could inadvertently slow down much needed additional new housing to feed into the millennial Gen Z demand. Similarly, in the labor market, a softening would help wage pressures soften a bit here. But a strong labor market helps pull people off the sidelines. Much needed additional labor as boomers are hitting peak retirement years.
Hey, sorry about that, guys. So my dog threw up directly on my 2-year-old. And she was absolutely devastated. She found that very, very upsetting. So I had to ditch for a minute. If you guys want to talk more about what the interest rate actually means, what Fed raising by 75 bips, what that actually does, we can do that. Let me know in the comments, or we can just keep watching Yahoo Finance if this is good. I missed the last couple of minutes, so I don't know what they were talking about.
Possibility for a longer expansion than most are anticipating now.
Well, and we'll hear from Fed Chair Jpow in just about 13 minutes from now. He has been optimistic that the Fed will be able to get inflation under control. From your view, when do you expect to see a significant, meaningful decline in inflation?
Well, what I'm looking for primarily is how broad-based the inflation pressures are. And we did for 1 month see the breadth decline. And that to me was a hopeful sign, but that went out the window with last month's print. So I'm looking for continued high inflation in rents, homeowners equivalent rent. That's something that's baked in the cake that will stay elevated for a while. But offsetting that, I want to see softness in goods prices. The seeds have been sown for that. Shelves have been restocked. The Fed has tightened a lot. It's hard for consumers to run up a credit card and not pay a higher interest rate. The seeds have been sown for a softening in those goods prices. That's what I'd be expecting to see going forward. It may take into next year, which is what the Fed is signaling they expect.
All right, so it sounds like people would rather chat than watch this blonde lady talk about things. We got about 10 minutes until Jpow starts breaking it down for us. His view of what inflation is going to do and his approach and how to tame it. So obviously the market's not too happy right now, giving away a lot of its gains. The only thing up is right now is some of the blue chips and GameStop doing its own thing. I love GameStop just for the reason that it's absolutely ridiculous. I think it's way overvalued, but I'm having a lot of fun trading it. But let's talk about something a lot more important here. So what does it mean when the Federal Reserve is increasing its interest rates to try to combat inflation? All right, well, let's start with some numbers here. So let's do a mortgage calculator. Let's do this by example. So what the Federal Reserve can actually do, their responsibility is either to add money to the economy in order to stimulate it, or to take money out of the economy, depending on if they're buying or selling from the government, basically. Adding to the funds pool of the United States or withdrawing it. Now, we've all heard they added a ton of money during the 2020 crash. Right? They added like 40 or 50% of the money supply in the United States. They added it during the COVID crash. Now their job, because they're like, oh shit, inflation is taking off, we need to remove money from the economy. So they're not printing as much, they're not giving away money at absurdly low interest rates anymore. The only thing they can actually affect is the overnight interest rate that banks can borrow from the Federal Reserve or lend to each other. I think they can do that too. Overnight rates. So really what they're doing is setting the rate at which banks can facilitate transactions, basically the margin rate for a bank for overnight fees. All right, that turns into setting the interest rate for a whole bunch of, basically for the banks that lend you money. Now let's talk about what the interest rate does when it's at, let's say, we were at 2% interest rate. All right, let's say you're borrowing $500,000, you as a consumer, at a 30-year rate. At 2%, your monthly payment is going to be $1,848. Okay. Now let's say they say, hey, the price of houses is getting way too high. Inflation is rising. The price of food is getting too high. People are able to borrow so much money that they're willing to spend more than we'd like people to be spending on things because it's leading to inflation. So once, let's say, houses are going up in price, now they're $700,000. Okay, your monthly payment on your mortgage has increased by only, was at $700. Now they're like, hey, this house just went up 200 grand. This house is getting out of, it's no longer affordable to people. We need to make sure that inflation doesn't price people out of the necessities that they want, like housing or food. We need to increase the interest rate so that people are no longer able to borrow money and spend at such low rates. So they increase their rate. They increase the overnight rate, and this leads to banks increasing their rates. This leads to treasuries increasing in price. That makes it more expensive for people to borrow and to spend money. So let's say they increase it to 4%. Let's say you as the consumer, you're willing to spend $2,587 on this item. It doesn't have to be a house. Let's just say $2,587. That's what you're willing to spend on it. Now, if interest goes up to 5%, all of a sudden you are way out of touch. You can't do it. You can't borrow $700,000 anymore. What did I say? 2,000. So at 2%. All right, 2,500. Let's say 2,500 is your goal. All right, if inflation goes to 5%, hey, you are $1,200 outside your budget. So in order to satisfy the consumer, the price of this service, this product, in this case it's a house, needs to come down. So let's say, is 500,000 enough? We just dropped inflation because we just dropped this price down. We're almost there. We're almost there with 500,000. So in order to get back into the American's budget, we probably need to go to $480,000, even less. Let's say $470,000. Now, we just went from a $700,000 item to a $470,000 item just by increasing rates to 5%. So if Jpow's goal is to make things cheaper, he needs to make sure that people can't borrow and spend like it's free money. So this is how he intends to cut inflation, by making things unaffordable to borrow and spend on, basically. Now, people have asked him this question during the press conferences. Is that a recession? Like, is your plan to fight inflation recession? And his answer has almost always been, well, in order to, our priority is to trim inflation. We're going to continue to use the tools at our exposure. He's saying yes. He's saying our plan to fight inflation is recession. And he never really said that, but he is implying it very strongly with the terms he's used. So what if interest rates go up to 7%? What if this hasn't happened? Okay, what if people were willing, even at 5%, to pay more money? What if people say, hey, my budget for this item is $2,500. Hey, it went up. Inflation happened. Now the item is worth $3,700. And they're still borrowing and spending it at 5%. Well, Jpow's plan is to increase it further. He's like, you know what? What happens if we go up to 7%? Are people still willing to borrow and spend? And so far, because inflation keeps rising, it looks like, yeah, they are willing to borrow and spend at 5%. Well, he says, okay, we'll raise the rate by another. This is a little bit high. This isn't what the actually is right now. I think it actually is like 400 or even less than 350. I don't remember what it just went up to. They were talking about it over here. But this is just for example. What if we raise another 0.75? He's playing chicken with the consumer. And people are saying, hey, rip the Band-Aid off, man. Go up a full percent. Don't go from 7 to 7.75. Go up to 7 to 8. Are people still willing to borrow and spend? Are banks still willing to borrow and spend at 8%, just like they were at 3%? And so far, he's had a really, really hard time getting people to stop borrowing and spending. So interest on a house right now, I just deleted my bookmark when I had it. I think it's approximately 6% right now. This is typically what the interest is on a house. Now, let's look at this. $4,200. That's just the principal and interest to borrow $700,000. 2 years ago, not even 2 years, yeah, 1 year, even, honestly, like 6 months ago, it was like 2%. So look, we're going from 4,200 down to 2,500. Just by increasing the interest rate, Jpow has made it approximately, oops. Why is that not working anymore? What is that, 2,200? I kind of lost track. 2,000 something. All right, it's at 25, and Jpow is raising it to 4,002. So like $1,700 is what he's raised it, and people are still willing to borrow and spend on houses. Now, what do you think is going to happen to home values when people are trying to sell for $700,000 at 6%, and the buyer is looking, oh shit, I can't afford that, versus when it was at 2% and it was at $2,600? Well, the price of the house is going to have to decrease. And that's kind of what's happening here. In order to fight inflation, we need to decrease the amount of buying power that consumers have. I mean, there's really no way around that. And Jpow's talking about soft landing like he's trying to, like he's going to be able to not crash the economy as a result of this, but I'm really skeptical that he's able to do it. All right, I want to get to youtube.com. Let's watch Jpow. Let's watch the Federal Reserve. So he's getting ready to speak in a couple of minutes here. He's usually pretty late, but let's see. It looks like they're live now. We're going to hang out here. We'll talk about it a little bit more. Anyway, those of you that were able to get in on a really, really low interest rate, like under 2.5%, congratulations to you guys. The lowest I've heard is 1.75%. That was a veteran, so he's already getting the lower interest rate as a VA loan borrower. I was able to get 4.25, and I felt really good about that because the interest rates on mortgages dropped for like 2 or 3 weeks, and during that span, I was able to lock in at 4.25. And 3 months ago, or 3 months ago, that would have been a great interest rate. 5 months ago, that would have been absurdly high. That would have been bad credit to get there. Now interest rates are like 5.5, 6. I mean, they're absurdly high. So those of you that bought at a low interest rate, congratulations to you guys. You crushed it. Mine's at 4.25, and I'm satisfied. I'm not happy, but I'm satisfied. It could have been a lot worse. So I missed the boat, frankly. I was not ready to move yet. I wasn't ready to buy a house during the COVID crash, or I felt like I wasn't ready to pick where I wanted to live, and I felt like interest rates would stay low a lot longer. But that was just my miss, huge miss on my part. All right, let's get Jpow playing here. I'll just turn the volume down for him. But I think most of the answer when it comes to buying your house isn't about what price can you get. The most important answer is what rate can you get, and do you actually want to live in the house that you're buying? If you're going to live there for 30 years, it's worth it to spend a little bit of extra money to get a house that you really want versus a house that you feel like is a great deal, but you don't actually want to live in it. So when you're talking about your primary residence, that's the case. When you're talking about buying something in order to rent it out and become a landlord, then of course the deal is really what you want to aim for. But in my case, I was buying a primary residence. Well, so it looks like a lot of people got in between 2 and 3, and that's great. Good for you guys. All right, who chooses the federal live stream music? I think YouTube default probably chooses it. What I'm really concerned about is how is this going to affect rent? Because I'm looking at I live in my house right now. I'm paying, $3,200 plus the insurance, so $3,300 a month to live in my house. If I'm going to move and rent this house out, I need to be charging like $3,500 for somebody to live here. That's high. That's really, really high. And I'm worried that a few years down the road, people that bought their houses in 2022, by 2025, they might want to move. They're going to start moving out. They don't want to sell their house because interest rates on their new house are going to be even higher. So they might try to find a way to turn this house into positive cash flow instead. We don't know what they're going to try to do. But if they were to rent it out, it's going to be a lot more expensive for in terms of charging rent versus if interest rates were 2% and they could charge a lower rate. So until we start building more houses, affordable houses, I think the housing crunch is only going to get tighter and tighter. I've got an entire script written out for that I'm going to record, I don't know, maybe on Monday or Tuesday once my equipment gets here. I'm trying to professionalize my talk to the camera interface a little bit more rather than just me talking to a chair. Sophisticated Investing with Joseph says that's not very good advice. You should buy a house that is a good deal, even if you don't love it. Better for your generational wealth. Okay, I disagree. I don't think you should get a bad deal because you love the house. But if you're going to live somewhere for 30 years, like your house. Like don't buy something that's not good for you in terms of finance just because you love the house. But you got to do a little bit better for yourself than trying to get a slightly better deal and then live somewhere you dislike for 30 years. Focus on what you like, and then once you've narrowed it down to things you like, now choose the best deal. But don't start with the deal. Start with your preference. Oh, here we go. I have Let's Play. What are you guys talking about? You guys not watching this? I'll refresh the page for you guys. I don't know.
Rate by 0.75 percentage point. And we anticipate that.
The hell was that? Oh, it was behind. I'm so sorry, guys.
Purposefully to a level that will be sufficiently restrictive to return inflation to 2%.
I forgot I had paused.
In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level. Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the Consumer Price Index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer-run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Questions, here we go. Let's hear it. He brought up some really interesting information there. We're going to talk about this after he's done.
Hi, Chair Powell. Thank you for taking our questions. Gina Smiley from the New York Times. I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
So I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done. So the way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular to achieve a period of growth.
Okay, I'm going to get some more tequila, and then I'm going to come right back.
Labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer-run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
Steve.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates Or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time that you could see pausing? Is it linear that you keep raising rates, or is there? Oh, I'm sorry. I should know better than to not talk with my microphone.
I should know better than to answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time, and I think we'll just have to see how that goes. There is a possibility, certainly, that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly today, we've just moved, I think, probably into the very lowest level of what might be restrictive, and certainly in my view and in the view of the committee, there's a ways to go.
Hey, Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So you're right. In the SEP, there is what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective,
Market
given the
loving what he's saying right now.
decline in inflation. Now, why is that? So really, that is what we generally expect, because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. And as I've said, there's no basis for complacency there. But to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are.
Hey, pause. A bunch of you motherfuckers are trying to comment, but you keep using foul language in your comments, and it's getting filtered out by YouTube. Stop using fucking foul language, and it'll populate the comment.
The kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say how much these factors will turn out to really matter in this sequence of events, it remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, or rather increase in unemployment and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether, also do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
Just to follow up on one small thing, are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles, where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Nick.
Nick Timmeros at the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know. You look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting, and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about, you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see, at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
Howard.
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly, and that's what we're thinking about.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here. Given there's some discussion now of overdoing it, what's the incentive to continue front-loading right now Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby. Thank you. Colby Smith with the Financial Times. Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025.
Core
and
inflation.
In the median, and headline is at 2.0. So that's pretty close.
I thought she was talking about
we write down
corn,
our forecasts, and we figure out what the median is, and we publish it. So it's not. I would say that if the economy followed this path, this would be a pretty good outcome. But you're right; it is a tenth higher than 2%.
Okay, just as a quick follow-up, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. That's how we think about it.
Victoria.
Hi, Victoria Guido with Politico.
In
I wanted
cahoots,
to ask
thank you.
about
She doesn't sound hot.
the balance sheet.
Yeah.
You all have
told you.
left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering
cahoots, thank you
whether
for the,
conditions there
for the super chat. Appreciate it.
Might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now, and not something I expect to be considering in the near term. It's just it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Neil.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment and price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us and vice versa.
I love how none of us are actually
The
commenting
forecast
on
that
the
we,
questions and
that
discussion.
we put together, that our staff puts together, and that we put together on our
We
own,
are
always take all
beyond,
of that.
we have
Try to take
evolved
all
beyond
that
the
into
need to
account.
talk
I mean,
about
I can't
the
say
actual
that we do it
economics.
perfectly, but it's not as if we don't think about, you know, the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, you know, I don't see it's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times. But really, we're in very different situations. But I will tell you that our contact is more or less ongoing. And it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future. And indeed, Treasury rates moved up. So we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient, and does it mean that we might need a possibly higher terminal
Thank you
rate?
very much for the super chat.
You're right, of course.
I
The
appreciate
labor
your-
market in particular has been very strong. But there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds, and housing price increases moving down. So we're having an effect on interest-sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening. But you're right. And we've said this. You know, this is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash, so there's a good reason to think that this will continue to be a reasonably strong economy. Now, the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that, and you know that's a good thing because that means the economy will be more resistant to a significant downturn. But of course we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus. And you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Mike, thank you.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below-trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward-looking and the lags in your policy are forward-looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
So I don't know what the odds are. I think that there's a very high likelihood that we'll have a period of what I've mentioned is below trend growth, by which I mean much lower growth, and we're seeing that now. So the median forecast, I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth, and then below trend next year. I think the median was 1.2, also well below. So that's a slower. That's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this. Inflation, what we hear from people when we meet with them is that they really are suffering from inflation. And if we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
Well, how will you know, or will you know, if you've gone too far?
It's hard to hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
Chris Rugaber.
Thanks. Chris Rugaber, Associated Press. I wanted to follow up with what you just mentioned about the labor market. You've said several times that to have the labor market we want, we need price stability, and you've suggested maybe there isn't a trade-off in the long run. But in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these rate hikes, or as a result of the rate hikes. So can you explain, though, what about high inflation now threatens the job market? I mean, you seem to suggest that inflation, high inflation will eventually lead to a weaker job market. So can you spell that out a little more for the general public and how that would work?
So for starters, people are seeing their wage increases, their wage increases eaten up by inflation. So if your family is one where you spend most of your paycheck, every paycheck cycle, on gas, food, transportation, clothing, basics of life, and prices go up the way they've been going up, you're in trouble right away. You don't have a cushion, and this is very painful for people at the lower end of the income and wealth spectrum. So that's what we're hearing from people is, it very much that inflation is really hurting. So how do we get rid of inflation? And as I mentioned, it would be nice if there were, a way to just wish it away, but there isn't. We have to get supply and demand back into alignment, and the way we do that is by slowing the economy. Hopefully, we do that by slowing the economy, and we see some softening in labor market conditions, and we see a big contribution from supply side, improvements and things like that. But none of that is guaranteed. In any case, our job is to deliver price stability, and I think you can think of price stability as an asset that just delivers large benefits to society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much, and that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back from the task of doing that is you're just postponing. The record shows that if you postpone that, the delay is only likely to lead to more pain. So I think we're moving to do what we need to do and do our jobs, and that's what you see us doing.
Thank you for taking the question, Mr. Chairman. Edward Lawrence for Fox Business. So you had said that Americans and businesses need to feel some economic pain as we go forward. How long from here should Americans be prepared for that economic pain?
How long? I mean, it really depends on how long it takes for wages and more than that, prices to come down, for inflation to come down. And what you see in our projections today is that inflation moves down, significantly over the course of next year, and then more the next year after that. And I think once you're on that path, that's a good thing, and things will start to feel better to people. They'll feel lower inflation. They'll feel that the economy's improving, and also if our projections are close to right, you will see that that the costs in unemployment they're meaningful, and they're certainly very meaningful to the people who lose their jobs, and we talk about that in our meetings quite a lot. But at the same time, we'd be setting the economy up for another long period. This era has been noted for very long expansions. We've had 3 of the 4 longest in measured history since we got inflation under control. And that's not an accident. So when inflation is low and stable, you can have these 9, 10, 11, 10-year, expansions. And you can see what we saw in 2018, 19, and 20, which was very low unemployment, the biggest wage gains going to people at the low end of the spectrum, the smallest racial gaps that we've seen since we started keeping track of that. So we want to get back to that, but to get there, we're going to have to get supply and demand back in alignment, and that's going to take tight monetary policy for a period of time.
As a follow-up, what is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it, down the road again, and doing it at a time when actually now people have really come to expect, high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises, and so we want to avoid that. We want to act aggressively now, and get this job done and keep at it until it's done.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. Existing home sales have fallen for 7 months straight. Mortgage rates are at their highest level since 2008. Yet mortgage demand increased this week, and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset, and what you think it will take to actually get there.
So when I say reset, I'm not looking at a particular specific, set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country, where, famously houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And that's a good thing. For the longer term, what we need is supply and demand to get better aligned, so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place. There are also longer run issues, though, with the housing market. As you know, where it's difficult to find lots now close enough to cities and things like that. So builders are having a hard time getting zoning and lots and workers and materials and things like that. But from a sort of business cycle standpoint, this difficult correction should put the housing market back into better balance.
Shelter made up such a large part of this hot CPI report that we saw. Do you think that there is a lag and that we will see that come down in the coming months, or do you think that there's still this imbalance that needs to be addressed?
I think that shelter shelter inflation is going to remain high for some time. We're looking for it to come down, but it's not exactly clear when that will happen. So it may take some time. So I think hope for the best, plan for the worst. So I think on shelter inflation, you've just got to assume that it's going to remain pretty high for a while.
Okay, we'll go to Jean for the last question. Hi, Jean Young with Market News. You've talked about the need to get real rates into positive territory, and you said earlier that policy is just moving into that territory now. So I'm curious, how restrictive is rates at 4.6% expected? Is that expected to be next year? How restrictive?
Sure. So I think if you look, when we get to, let's assume we do get to that level, which I think is likely, what you're going to do is you're going to adjust that for some forward looking measure of inflation. And, that could be, you pick your measure. It could be, there are all kinds of different things you can pick and you get. But what you'll get is a positive number. In all cases, you will get forward inflation expectations in the short term, I think, that are going to be, assuming that we're doing our jobs appropriately, that will be significant. So you'll have a positive federal funds rate at that point, which could be 1% or so. But I don't know exactly what it would be, but it would be significantly positive when we get to that level. And let me say, we've written down what we think is a plausible path for the federal funds rate. The path that we actually execute will be enough. It will be enough to restore price stability. So this is something that, as you can see, they've moved up, and we're going to continue to watch incoming data and the evolving outlook and ask ourselves whether our policy is in the right place as we go. Thank you very much.
All right, Jpow abruptly ended his conversation, but I think this was very, very interesting to see what he had to talk about. Oh, I like that music. Let's let it continue. Yeah, so all right, the event is now ended. Jpow was very abrupt. I don't know if he had some kind of time limit or something, but he's like, hey, we're going to wrap this up now. Basically what he said, there's nothing too surprising there. He's accepting that there's a risk to the economy by continuing to increase the rate. He gets that. But his priority is to make sure that inflation gets trimmed. And best case scenario, we start going into a flattening of inflation and then a slight down so we can achieve that soft landing. Now, in my opinion, I think that's going to be very, very difficult for him to achieve. And by difficult, I mean pretty much impossible. It's out of his control. It would require the market in general and the consumer to play into what he has in mind. And I just don't think it's going to work out realistically. I think we're going to wind up in a spot. Oh, here we go, FOMC. That was 2017. All right, let me know if you guys want me to play this. We can turn it down. I'll turn on closed captioning if you guys want to read it. But I think Jpow is not going to be able to achieve his soft landing objectives. I think he's going to wind up in... It's not working. Let me see if I can get the subtitles on. Yeah, there we go. Okay, so this is Janet Yellen. This is 2017, see what she's talking about. Now, I think the play here is going to be to focus on yourself. And one of the things that's made a tremendous difference for me, even though I have money, I'm not super rich anymore. I'm not broke either. But one of the things that has made a difference for me has been to perform freeloading. And if there's one service that has made a difference, it's the Freeloader Challenges focus groups. And you can see the pinned comment there. I just did one this morning. I made $200 for talking about how if a small business icon, like identifying something as a small business, is making me more likely to click on it or not. That's it. All I did was give my opinion on that, $200. So if you guys are interested in doing something like that, and I strongly, strongly recommend you do, use user interviews as one, and then join our Discord for the rest. There's a whole channel on our Discord. It's free Discord, just talking about how to freeload money, and focus groups are just one option. So definitely join us there, make money. You think if you can make an extra $200 a month, over time it's going to add up significantly. You're talking $2,400 a year. For a college student, for a young person, that is a huge amount of money. So definitely do that. Focus groups are the play, James Chapman, especially if you reinvest that money into something that's going to earn you some interest over time. Definitely do focus groups. There's plenty of ways to make free money. That's the whole point of the Freeloader Challenge. But I think if I had to pick one, it would be focus groups. That's the way to go. And Alex G, I think 10 out of 10, yes, definitely. Now, what should we do now? Somebody drop the Discord link. Here, let me get the Discord link. I'll get you guys the Discord. It is a free Discord. There's paid groups on the for Patreon. If you join Patreon, you'll get access to a couple extra channels. But as far as the overall, most of the discussion takes place on this. So join it in there, and you'll get to join. You get the Market Talk channel, you get the Frat House channel, you get the Freeloader channel. What else we got in there? We got to talk about cryptocurrency, Frat House, Market Talk, shorting China, which you should absolutely do, and the Freeloader Challenge channel. You get the paid channels if you sign up to Patreon as well. But I mean, that's up to you whether you want to do that or not. Really, I think, honestly, we're going to have a really, really hard time getting ahead of the inflation problem, of the housing problem. All of these things are just going to roll into each other. And we're going to wind up with Jpow trying to play catch-up the entire time, bringing this economy back on track. Redhead in the back. Definitely 8 out of 10. Now, what we should be doing, focusing on our portfolios right now, continue to dollar cost average. Honestly, there's really no way to lose if you just dollar cost average into the indices. But you should be either hedging against those positions, or you should be investing in something that's going to help you make money while the rest of the market drops. You don't want to keep investing in SPY when SPY continues to drop. I think the way to go right now, buy into SPY, do it, but I'm going to spend my dividend for October, which is going to be about $3,000. I'm going to put that all into longer term, probably 3, 4, 5 months, put positions, at the money put positions. It's going to cost me about $3,000, but I'm going to be able to get an at the money puts put on SPY. I think we've probably got more room to drop. I think those June lows are back in play. You know, it's been 3 months now. It's about time we start hitting those lows again. I would love if we don't. I would love to see the market make a higher high, or a higher low rather, and start its trajectory up. I don't think we're there yet. I think Jpow has a lot of work to do, personally. Some of the other industries that I like, the highest risk one right now, but the one that I think has a lot of potential, is the semiconductor industry, domestic semiconductor industry. So we're talking about a handful of companies that have all put money into developing semiconductors in the United States, which is a very expensive endeavor to do. But the U.S. has recognized how important it is that this resource, which is a strategically important resource, is produced in the U.S. instead of Taiwan. So we've got companies like NVIDIA, I think there's at least a couple of more that are building plants in the United States. So LRCX, it's been pretty beaten up right now. I think now is a good time to get in for looking at a long-term goal, a long-term investment into LRCX. They make the companies that other chip producers need in order to produce their chips. So I think they will benefit from this push to get domestic production of semiconductors into the United States. Intel is another one. Millennial investor, yes. Intel, I think, is building chips. But more importantly, I think the ones that are really going to benefit from this are the ones that build machines on behalf of Intel and NVIDIA. Longboard Lifestyle, yes. ASML, I think they are a Dutch company. I think it's Dutch. Very, very similar to what LRCX is producing. I think there's something with a K, too. That might be the Dutch company. ASML and like KML or KLM, something like that. They're another company who does basically the same thing as the LRCX does, but LRCX is American. So, I'm doing my patriotic duty by choosing LRCX. Let me see. Millennium Investors, Intel, Veco. I'm not too familiar with all these right now. Intel will build NVIDIA chips. Okay, so bringing domestic production of chips to the United States, if I were the president right now, I think that would be one of the most important, honestly, the most important thing that we could do. If we want to take an edge against the Chinese, who are probably going to take over Taiwan in the next 10 years, we need domestic production of semiconductors. That can only be achieved with significant support from the federal government, and I think they know that. That's why they're pushing things like the CHIPS Act. That got passed. It's probably a lot more work to do, but I think we can get there if we continue to commit to it. So that's a play that I think is going to, it's going to take years and years to play out. But LRCX is still one of my favorites, even though it got trimmed even more than the NASDAQ this year. But that's what happens to a bear market. Now is a good time to load the boat in anticipation of this big push over the next decade to bring that production back to the U.S. That's my point of view. All right. What else do you guys want to talk about right now? I mean, this is an hour-long speech by Janet Yellen from 2017. I don't know if this is what we need to be looking at right now. If I were not live streaming, I would probably be producing my next video. If you guys have any interest at all in seeing the behind the scenes of how I produce a video, let's do that together. I'll be more than happy. Let's look at what the market's doing while you guys let me know if I have your permission to do that, or if I should just end the stream. I mean, we can do that too. Let's see. GameStop is actually up. That's fantastic. Hey, every time Altria drops below 42, buy shares. Every time it drops below 42, it rises back up like clockwork. 42 is something special for Altria. 8.76% dividend. I mean, that's fantastic dividend. I love this company. I don't love the company. I love the stock. I'll say that. All right, you guys want to do a little behind the scenes. Tom Cat says he's loving the 3K challenge series. Behind the scenes of 3. So we can do the 3K challenge, or we can do the dictionary of degeneracy. I mean, we could do either one. You guys let me know what you want to do. I'm going to poke around for a little bit. Dow was down. It's pretty flat, though. I mean, this, you know who won today is Theta Gang. Theta Gang absolutely won this one. The NASDAQ, Russell, crude, gold. Let me see. So crude is, I'm actually pretty satisfied with the way crude is going. I thought it would increase further after the announcement that Russia is going to invade Ukraine more. Anyway. Yes, James Chapman brings up a good point. He says, if you paid off your student loans in the last 2 years, you are eligible for a refund starting in October. So personally, I think we should be going a lot further back than 2020. I think we should go back to like the 90s to reimburse people in the form of tax credits. Well, we'll see. All right, you guys got to let me know. Do you want to do, we'll do some behind the scenes because I do want to spend the next half hour or so producing video content. Would you guys rather see the behind the scenes of how I produce the 3K challenge, or would you rather see the dictionary of degeneracy, in which I'm talking about the memes of and the ongoings of Wall Street bets, the status of the community, so to speak, maybe like a state of the union on Wall Street bets. We can do either way. You let me know. I got to take a piss bad because I've been sucking down tequila since we started this thing. I will play this guy in the meantime, so you guys have at least something to look at. Where are we at?
Perform in the S&P 500. Communication services, materials, that could be a dollar play. We can get to that in a second. Financials, those are the biggest losers, but nothing off by more than about 0.5%. And I just want to show you the stock movement in the S&P 500 on a longer term basis. That's the dollar. Let me get to the S&P 500. Here is today's price action. Now, this exceeds the price action of the prior 2 days, which is to say we went down, we went up, and we're back in the middle. And so everything is copacetic. From the Fed's point of view, still fighting that inflation, we saw the VIX spike up to over 30. That was the highest amount in about 2 months, 6 weeks, something like that. And also taking a look at the bond market. Now, this is usually where the fireworks are. We see the 5-year T-note yield. It did spike to a new high. It is down 4 basis points right now. The 10-year T-note yield also made a new multi-year high, I think the highest since 2007, don't quote me, but ending down on the day. And the 13-week T-bill yield, now this is a key one too. This has been racing higher. This more accurately tracks, it's on the short end of the curve, what the Fed is doing with its benchmark interest rate, which is an overnight rate. This did not make a new high. So really, this is a press conference, and I think we're
back, mission accomplished. All right, we got, let me see. Most people say 3K challenge. I was really hoping you guys would say dictionary. But, all right, we're going to do the 3K challenge because I'm a man of the people. So we're going to do 3K challenge. All right, let's open up Vegas Pro. This is what the behind the scenes looks like. So we are going over here. Okay. So here's the way I make the 3K challenge videos. Whenever I record something on my, usually it's on my phone these days, sometimes it's on desktop, I'll record it, I'll write up my script, and then I'll record the sound. So I typically wind up what you see here. I have background with just my voice describing what I felt like at the time of the trade. Now I need to go back and I need to make the actual video portion, which I've recorded. I'll pull it right off my email, drop it right in. So let's see. this is what I got so far. Welcome back, everyone, to Season 2, Episode 6 of the 3K Challenge. Last episode, a lucky post-earnings jump on GameStop brought my account up to about 3,820, or just over 9% overall. My goal for this week is to finish the next Dank Trades episode. Wow, I'm a fucking dumbass because I left my microphone on mute the entire time. What I was saying was, when I'm recording something on my phone, sometimes it's on desktop, I will record my voice at the time of the trade, but then I get stuck with just a voice and a background. I need to go back and actually make the video now. So I'll import my stuff from the recording, and then I will make the video from there. So what I wind up with is, this. Welcome back, everyone, to this is a $1 wide spread, so it's not going to see much movement in price. So that's me talking about my feelings about this spread at the time. So, Jorge, thank you so much, man. I really appreciate the super chat. Thank you so much. He says he feels like he's been freeloading off my content, so he'd like to send some money to send thanks. So I appreciate you. Thank you so much. Appreciate you giving back. Those just joining, we're doing some behind the scenes of what my video production actually looks like. So all right, Stick and Ball Sports asks me, what are these cuts? So these cuts are where I cropped my footage, my audio. So if I'm describing, let's see what I talked about right here. So let's open her up here on Monday, September 12th. The market is having a good day, and GameStop is climbing with it. So I'm over 3,900 again. It's a good. So, all right. So I was describing what GameStop was doing on Monday, but there might be a spot where I stutter or I say SPY, but I really meant QQQ or something like that. So I'm like, oh shit, I say it again. Rather than start a new recording, I'll just correct myself in the same recording and then trim it down, and I'll cut my mistake, and then I'll just continue on. So occasionally these will all be one take, but it's very, very rare that I'll be able to get through, more than 50 seconds without making some kind of mistake. So, and then we've got something like, let's go over here. My error just kicked on. Let me know if it's a problem. So I'll go over here. Shit posts. Yes. Shit post. Dictionary 3. Oh, yeah, here we go. Okay. So if I open up dictionary, so this is the Wall Street Bets Dictionary of Degeneracy. This one will be a little bit different. You can see the audio is pretty much one solid take. I'm going to just trim a couple of points out of that. So let's see. Bertman, thank you for the super chat. Appreciate you so much. I love when people super chat me. That makes me feel so special. So here's what I got so far for the Dictionary of Degeneracy. I'm going to work on these two videos together and probably produce back and forth to each other. I think this intro is fucking legit. So, you heard all about Wall Street bets, and now you want to hang out with the autistic kids, huh? Before you kick in the doors to this party, you gotta learn our language. Before you kick in the doors to this party, you gotta learn our language. Before you kick in the doors to this party, for example, you can say I said the same thing twice because I made a mistake. That's why you get these cuts. Before you kick in the doors to this party, you gotta learn our language. Let's see if we can get you up to speed. All right, so that's how I produce the content. So anyway, let's close this one out. Let's do, oops. My priority right now is going to be to make sure that I get the 3K challenge out. Rishi asks me, how do I trade in the 3K challenge versus my main account to make it fun to watch? So my 3K challenge is, there's not a whole lot of buy and hold stuff going on there. It's mostly just trading, and that's the difference. My main account is like 60, maybe 70% buy and hold positions. I'm confident that I can perform alongside or beat the market, but I want to hedge against my own overconfidence. Yep, we got Chat 69 back. We're going to ban him. We're going to ban Chat 69 because it's all spam. Anyway, I'm not confident in my confidence, put it that way. I think that as long as I don't do anything stupid, financially, I'm going to be in great shape as I go forward. All I have to do is not screw up. So I'm hedging against my screw-ups by keeping about 60 to 70% of my positions in indexed ETFs. So anyway, let's do the 3K challenge. Once we're down below 100 viewers, I'll probably just wrap this up, but I think there's some people here that are interested in seeing how I do it. So let's make some content.
Welcome back, everyone, to Season 2, Episode 6 of the 3K Challenge. Last episode, a lucky post-earnings jump on GameStop brought my account up to about 3,820, or just over 9% overall. My goal for this week is to finish the
Alright, so now I'm going to go through my stock photos and find, I think I have a Wall Street Bets banner in here. So this is just a great way to add some extra content to it. Make it look fancy pants. It's a little bit too big. Let's shrink it down. Yeah, I do pretty much all my editing myself. Occasionally I'll get somebody else on board to help out, but I think that people tend to really like when I do it myself. Some people probably appreciated that freeloader challenge video I hired someone for, but I think most people prefer that I just do it myself. So let's see. So we'll make some extra text.
My goal for this week is to finish the next Dank Trades episode. Not gonna lie, that's my priority because nobody is watching these 3K videos anyway.
Alright, so I did that because this took place on September 12th when I was recording this. So we're talking about like, what, 9 days ago? I already made that video. So this would be a good opportunity for me to put these, where are we at? Let me see, 3K, no. Dank Trade, yeah, Dank Trades. So this is a good opportunity for me to put my next guy, Toofy, Holly, Diabolical. Where's Nep? Oh, here's Nep. Alright, so trailer, yeah, let's put the trailer in here. Okay, so I'm going to shrink this video. So this is the video that I made for Nep, his Dank Trades video that got me called a racist. Actually put me on like YouTube's shit list for a little bit. I used a Vietnamese person to voice over a Chinese character, and the internet was very upset with me. Alright, but see, this is a good time for me right now. So I'm talking about, hey, I got to make this video this week. That was on September 12th when I recorded that. Now the video is made. This is a good opportunity for me to plug that video, which I'm very proud of. I think I did a great job with this. So let's put, alright, we got the video out. Let's put a background. Let's do a little orange. Oh, I need another video track. Let's put a little orange behind it. We don't need this audio track. And we're going to use a mask and delete that first, and then put a mask around the border of this video. Alright, that should be close enough. Alright, it's a little thick, but it'll do. Alright, now we're going to shrink it down to the appropriate amount of time.
My goal for this week is to finish the next Dank Trades episode. Not gonna lie, that's my priority because nobody is watching these 3K videos anyway.
Alright, so let's shrink this down as much as possible. Now we're going to shrink it so it's sped up.
My goal for this week is to finish the next Dank Trades episode. Not gonna lie, that's my priority because nobody is watching these 3K videos anyway.
Alright, so it's going to have to do. Sped up a lot. Doesn't look like anything right now, but we're going to continue talking about the weekly goals.
But for the 3K challenge, I'm planning on spinning the GameStop wheel again.
Alright, so I'm talking about GameStop next. Now I'll go back here into my stock photos, and I've saved a bunch of these. GameStop logo. I think there's another GameStop. Oops. GameStop logo, red outline. All right, so I'll use the red outline one. We'll come here. Yep. All right, and now I'm going to use. Now I have a wheel. GameStop logo. So this is, I mean, I'm right now, this is why it's hard for me to find an editor that I really like, because a lot of what I do is kind of like spur of the moment. So right now I'm talking about GameStop wheels. Well, you know what? I have an image of wheels already. All right. I'm going to put that right there. And I'm going to move the middle of this wheel over here. Now, while I'm talking about GameStop wheels, I think it's a great move to make this wheel spin. So let's see what this animation actually ends up looking like.
But for the 3K challenge, I'm planning on spinning the GameStop wheel again to work. So let's open her up here on...
Alright, so it's not until here that I start shifting over to Robinhood. So let's make a keyframe right here. So I'm telling Vegas Pro that I want my wheel to look like... Let's go the other way. I want my wheel to look like this. Alright, so let's do a couple of rotations. Shrink it down. Alright, and let's go back to see what this animation looks like.
But for the 3K challenge, I'm planning on spinning the GameStop wheel again and also putting some of this growing cash pile to work. So let's open...
Alright, what do you guys think of that? Should I recenter my wheel to make it look a little bit tighter? I think I'm going to do that just a little bit. Recenter my wheel. Now let's see how it looks.
But for the 3K challenge, I'm planning on spinning the GameStop wheel again and also putting some of this growing cash pile to work.
That'll have to do. Alright, let's see if there's any comments here. We're still over 100 viewers. I can't believe that. I thought everybody would have left by now. Rishi says the voiceover has a large hall-like effect. I'm not familiar with that effect. Does that mean echo?
My goal for this week is to finish the next Dank Trades episode. Not gonna lie, that's my priority because nobody is watching these 3K videos anyway. But for the 3K challenge, I'm planning on spinning the GameStop wheel again and also putting...
Alright, let's try. Let's see what you guys think. What if I make the GameStop wheel just a little bit small, like the GameStop logo a little bit smaller, so you can see a larger portion of the wheel? Maybe make the wheel look a little bit more... Make the wheel look more spinny.
But for the 3K challenge, I'm planning on spinning the GameStop wheel again and also putting some of this growing cash pile to work.
I wish it would, like, just look a little bit better. Because it looks like it's moving just a little bit. This is why it takes so long to make a video.
But for the 3K challenge, I'm planning on spinning the GameStop wheel again and also putting some of this growing cash pile to work.
Alright, that'll have to do. I think that's pretty good. It's a lot boomy. I mean, I can make the sound a little bit less booming. I mean, how's this sound for you guys?
My goal for this week is to finish the next Dank Trades episode. Not gonna lie, that's my priority because
so
nobody's
down.
watching these 3K videos anyway.
That's
but for the 3K challenge, I'm planning on spinning the GameStop wheel
Usually
again
it's like
and
this.
also putting some of this growing cash pile to work.
Yeah, let me know what you guys think of that, because this is always something I can't quite tell how it's going to sound. Anyway. Oh, it's because I got the stream going on at the same time that my mic is going. That's why it's doing that. Why don't I turn that down a little bit, and you guys will only hear one. I'll turn down the audio output. So you guys are you're going to hear it through my mic, but that should help out. All right, so let's continue on here. So, all right, I'm describing my wheel, but I need to now add text that describes it. So let's do this. We're going to need another video layer. All right, so I'm going to add in I'm describing my goal for the week. So let's cut it down. I don't know, how's 30 look? Now I can do a little better. I want to do 40. And I don't want to make it look the same as the title color, so I'm going to do this is the Robinhood logo color. 20 to 100, oops, 130. I can change sizes during the video if you want me to. I don't know if it's necessary to do that. I can even make this text a little bit bigger, can't I? I mean, I could start it like this and then shrink it.
But for the 3K challenge, I'm planning.
I mean, I can do this. I don't think this looks good, but I mean, I could do it if I wanted to. Start off big and then go like this.
But for the 3K challenge, I'm planning on spinning the game.
I don't want to do that, but you guys let me know if you think that looks cool or not. Alright, so here we go. I'm describing my intentions with the wheel.
But for the 3K challenge, I'm planning on spinning the GameStop wheel again and also putting some of this growing cash pile.
Alright, now I've got another. So let me take a picture. Let me go into my video. So the video, September 12th. So here's the video that I took. Oops. So here's the video I took. Alright, now on September 12th when I took this video, I had this buying power. So I think this is a good way for me to snip this buying power picture. Alright, I'll go back over here to my PowerPoint where I'm making the images. Alright, and now I don't want all this space. I want like a square shaped image. So I'm going to do this. I'm going to copy it twice, zoom in, crop it this way, crop it that way, put them right next to each other. My dog just threw up again, according to my wife. I'm hearing it. She's scolding my dog upstairs. Okay, so we're going to snip it so that I can make it into one image. All right. And now we're going to put a glow around it so that it looks like something. Put a nice little orange glow. All right. Now I got to save the image. We're not doing it here. We'll do BP. And where's my BP? Okay. All right, so we're good. I've got that now. Now I can talk about my intention with this buying power.
But for the 3K challenge, I'm planning on spinning the GameStop wheel again and also putting some of this growing cash pile to a wheel again and all.
All right, so that's a good opportunity for me to dump in the growing cash pile right there. All right, we have gone down below 100 viewers, so I think it is beyond a time to wrap up this stream. But I want to thank you guys for tuning in. Those of you that even stuck around a little bit to watch the production behind the scenes, I do appreciate that. Join our Discord. You'll get more access to us. A good way to talk to like-minded people who are interested. Maybe we have different points of view. Maybe we can come to some kind of arrangement that we both think is a great investment. So there's nothing to lose by chatting us up. The freeloader channel is really doing great. People putting a lot of work into maximizing our freeloading. But join our Discord. I want to thank you guys all. Let me see if I can pull up that Discord link once more. And pull up the link one more time. Yeah, if you're not in Discord already, check it out. Join us. It's a good time. And I will see you guys next time. So thanks for joining.